Welcome to this webinar regarding municipal financial statements. According to the provincial legislation, all Saskatchewan municipalities are required to submit their annual financial statements to the minister. This webinar is intended for use by municipal administrators and clerks. In this webinar, we will discuss what are financial statements and why they are required from municipalities, who establishes accounting standards and why they periodically change, impacts that new accounting standards can have on municipalities, and how to prepare for those changes. An overview of resources that are available at saskatchewan.ca to assist municipalities with the preparation of their annual financial statements. We will also discuss the following important accounting concepts: accrual accounting, the relationship between budgets and financial statements, and accounting for partnerships. Finally, we will discuss how to prepare for an audit of municipal financial statements. Your administration is responsible for making decisions on the use of municipal resources. In the case of a municipality, the resources come from the taxpayers and other stakeholders. Since all taxpayers cannot be part of a municipal administration, there is an information gap between municipal administration and the taxpayer, who are major contributors to municipal resources. Financial statements are intended to close this gap as much as possible and make municipal financial operations more transparent. To do so, each municipality is required to follow a set of accounting standards to report on municipal finances. The accounting standards limit the impact of bias on financial reporting that municipal decision makers may have. According to Sections 185(1) of the Municipalities Act, 207(1) of the Northern Municipalities Act, and 155(1) of the Cities Act, municipalities are required to prepare financial statements in accordance with the generally accepted accounting principles for municipal governments recommended from time to time by the Chartered Professional Accountants of Canada, called CPA Canada. Sections 186(1) of the Municipalities Act, 208(1) of the Northern Municipalities Act, and 157(1) of the Cities Act require each municipality to submit its financial statements and auditor's report on the financial statements to the minister by July 1 or September 1 for cities of the year following the financial year for which the financial statements and the audit report have been prepared. According to CPA Canada, Public Sector Accounting Standards, or PSAS, are the standards applicable to government entities, which include municipalities. The Public Sector Accounting Board, or PSAB, is the regulatory body in Canada that determines the accounting standards for the government. Accounting standards are set at the national level to make the financial statements of Canadian organizations comparable to each other. Updates to accounting standards are necessary for various reasons. The two main reasons that provoke changes to accounting standards are changes in the environment where organizations operate and the need to address newly appeared accounting issues. When making changes to existing standards or adopting new ones, PSAB consults with stakeholders from across the country. The consultations include recognized professionals from a variety of organizations. Their opinions are considered in shaping the proposed changes to the standards or even setting new ones. Some municipalities may find it difficult to implement some newly introduced standards. This has been the case with PS 3280, the standard on asset retirement obligations. These standards became effective for Saskatchewan municipalities for the 2023 financial statements. If a municipality does not comply with an updated accounting standard, it may cause the auditor to issue an unsatisfactory opinion or provide comments known as an audit qualification on the financial statements. The hardship of complying with new standards, like PS 3280, could be the high cost of hiring consultants to provide reasonable estimates. In cases like that, municipalities may be able to reduce costs by collectively procuring their services. Alternatively, different auditors may have different opinions on what constitutes a reasonable estimate. Therefore, some auditors may be open to more affordable methods to acquire them. Municipalities may decide to look for an auditor open to use the methods within their budgets. A good practice for municipalities could be to start preparing for the adoption of changes to the accounting standards ahead of time. This would prevent delays in the preparation of their financial statements when new accounting standards take effect. The Ministry of Government Relations releases material to assist municipalities with the adoption of new accounting standards. The supporting resources include the guides and info sheets on the accounting standards effective for municipalities for the years 2023 and 2024. Please find this material on the same page where this webinar is available. Besides the material specific to the new standards, the Ministry also prepares and periodically updates the Municipal Accounting Manual, known as MAM, and the Municipal Audit Guidelines, called MAG. This material is meant to assist municipalities with the preparation of their financial statements. The MAM is prepared for administrators to help them better understand the purpose, presentation, and disclosure requirements for financial statements. This is a valuable resource for administrators to utilize when preparing their municipality's financial statements ahead of the annual audit. The MAG document has been prepared to assist municipal councils, administrators, and auditors in carrying out their respective roles and responsibilities related to the conduct of financial statement audits. Both MAM and MAG provide guidance on how to read and understand financial statements and reports prepared by the auditor as part of their audit. You can find this material on the same page where this webinar is available. According to public sector accounting standards, municipalities should prepare their annual financial statements following the accrual accounting concept. However, cash accounting is more popular in smaller organizations. Let's compare cash accounting with accrual accounting. Cash accounting is a straightforward way of accounting. Transactions are recorded only when money changes hands. This means that revenues are recognized when cash is received and expenses are recognized when cash is paid. Small organizations prefer this accounting method because it's easy to manage and it gives a clear picture of cash on hand. Let's look at an example. Imagine a municipality issues a parking ticket to a resident on July 15th for $20, but doesn't receive payment until August 4th. Under cash accounting, the $20 revenue is recorded in August when the payment is received. Another example of cash accounting would be when a municipality purchases a building for $500,000. Cash accounting records the entire cost as an expense in the year of purchase. This accounting record does not consider the asset's long-term use. It makes the event of purchasing and using of the asset appear as a large one-time expense rather than spreading the cost over its useful life. Therefore, while the cash accounting method simplifies bookkeeping, it does not provide an accurate financial picture of how the asset contributes to operations over time. Let's now look at accrual accounting. Accrual accounting records revenue and expenses when they occur, not when cash is exchanged. This method gives a more accurate financial picture, which is why organizations are often required to use it in their financial statements or other financial reports. As per PSAS, financial statements are to be prepared using accrual accounting. Much like our first example, let's look at it under accrual accounting. Imagine a municipality issues a parking ticket to a resident on July 15th for $20, but doesn't receive payment until August 4th. Under accrual accounting, the municipality records the revenue in July because that is when the event giving rise to the revenue took place. Let's consider our second example under accrual accounting as well. The $500,000 cost of the building is spread over its expected lifespan through annual amortization. This method ensures that the expense is matched with the periods benefiting from the asset, providing a clearer financial picture. Under accrual accounting, instead of a large one-time cost, the expense is recorded gradually, reflecting the ongoing use of the asset and better supporting financial planning. In a nutshell, the main difference between the two methods is that cash accounting focuses on real-time cash flow, while accrual accounting provides a broader financial picture by recognizing revenue and expenses when they occur. Each method has its pros and cons. Cash accounting is easier and more intuitive, but it does not provide the same level of accuracy in financial information. Accrual accounting, on the other hand, provides a more accurate long-term view of financial health, although it is a bit more complex. Since accrual accounting provides a more accurate picture of an organization's financial health, that is the basis on which municipal financial statements are prepared. The auditors review the municipal financial statements and provide their opinion on whether they are free of material errors. This assurance makes financial statements a more reliable source for decision-making. Municipalities are also encouraged to use accrual accounting when recording daily transactions. This would help reduce the amount of work required during audit time and make municipalities more comfortable using financial statements as part of decision making. The next important accounting concept that we'll discuss is about the relationship between budgets and financial statements. Municipal budgets provide staff with the guidance needed to achieve the municipality's goals for the year. A budget is also a way to communicate municipal council financial decisions and plans to its residents and other stakeholders. Once the year is passed, the comparison of the results, which are often referred to as actuals, with what was budgeted helps the municipality with the evaluation of its actual performance against the plan. According to public sector accounting standards, both the actuals along with the corresponding budgeted numbers should be presented in the financial statements. However, municipalities often prepare their budgets using cash accounting. This creates a challenge and compromises the value of the comparison with the actuals recorded in the financial statements using accrual accounting. Adapting budgets according to an accrual accounting concept helps the municipal council and other stakeholders better evaluate the municipality's performance. A sample of a budget form is provided at the bottom of the provincial government website page indicated here on the right side of this slide. The form is built in a way to provide the necessary comparatives to the financial statements. For more information on how to prepare a municipal budget with line-by-line comparatives for the financial statements using the sample budget form, please consult the MAM, which we discussed earlier in this webinar. Let's move on to the last important accounting concept discussed in this webinar: partnerships. Partnerships is a concept defined under public sector accounting standards that affects many municipalities, but may be found difficult to understand by municipal administrators. In general terms, a partnership is a contractual arrangement between the municipality and one or more outside parties, such as other municipalities, where the partners work together to achieve common goals, make financial investments in the partnership, share control of decisions, share the risks and benefits associated with that partnership. Most partnerships should be accounted for using the proportionate consolidation method. This means that the municipality's pro rata share of the partnership's assets, liabilities, revenue, and expenses are combined with those of the municipality on a line-by-line basis. For example, if the municipality's share of the partnership is determined to be 20% and the partnership has, among other things, $1,000 cash balance at the end of the fiscal year, the municipality should add 20% of $1,000 or $200 from the partnership into its own cash balance in its financial statements. The same should be done for all other assets, liabilities, revenue, and expenses from that partnership. If you are unsure whether your municipality has a partnership, make sure to present all the facts and documentation to your auditor so that they can assess whether any adjustments to the financial statements are required. Lastly, let's discuss how to prepare for the audit itself. Preparing for the audit of the municipal financial statements helps expedite the process and makes it straightforward for both the auditor and the municipality. Some of the most important work that can be done in preparation of the audit include preparing journal entries to account for changes stemming from accrual accounting, such as the amortization of assets over the course of the year, reconciling bank statements with the transactions recorded in the municipal general ledger to ensure no transactions were missed, gathering invoices, receipts, statements, and any other relevant documentation to support the accuracy of the recorded transactions, gathering bylaws, resolutions, and any other relevant documentation that supports the method used to levy taxes and establish rates used to charge consumers for water, ensuring minutes of council meetings properly authorize expenditures and other financial transactions, and verifying those minutes are properly signed. For more information on how to prepare for the audit of municipal financial statements, please refer to the Municipal Audit Guidelines available at saskatchewan.ca and mentioned earlier in this webinar. If you have questions, please contact the Municipal Infrastructure and Finance Branch of the Ministry of Government Relations. Thank you for watching.